leave, but we're going to go ahead and get things started here. So, welcome everyone, as always, to our January 2026 FOMC panel of experts. Now, today we've got a ton of topics. I know I say that for every single one, but today it's starting to feel like maybe a little bit more than usual. The economy keeps throwing mixed signals. Growth is still holding up, but confidence seems to be fading a bit. Housing affordability remains tight, and markets can't really seem to agree on what the Fed's next move should be. We've also got trade tensions back in the headlines. Safe haven assets like gold and silver are ripping to significant all time highs, seemingly every day at this point. In tandem with that, equities are kind of doing the same. I know we got a little bit of up and down today, but they do seem to be moving in tandem, which we'll talk more about later. On top of that, policy pressure is rising and data has been sending some conflicting messages, and there's plenty for the Fed to handle today. So let's jump in to a couple of our introductions for those we've got so far. Starting off, as always, we're excited to welcome back Joseph Wayne, better known to most of you as the Fed guy. Joseph previously ran trading on the Fed's open markets desk, literally working inside the machine, and he's now the CIO at Monetary Macro. He's also the author of Central Banking 101, which somehow manages to make the Fed understandable. Joseph, great to have you back as always, man. How you doing?
And thanks so much for having me. It's great to be here. It's great to be with my friends on the panel again. So, looking forward to a great discussion.
As am I. Thanks for coming, Joseph. Up next, we've got another frequent flyer on the Unusual Whales Air, the last bear standing, focusing heavily on markets and monetary policy, and puts out some great weekly analysis on his Substack. If you're not already subscribed to that, that's your homework after the panel. Welcome back, Last Bear.
Hey guys, thanks for having me. Looking forward to the first FOMC of 2026. So thanks always for having me on the panel. Looking forward to the discussion.
And thanks as always for coming, man. Love getting your input on a lot of these topics. Next, we've got Martin Peltier. Martin is a portfolio manager at Trivest Wealth Council, a regular contributor to mediums like the Financial Post, and possibly the only person on this panel who can talk macro all day, every day, and still wake up early to cut up the slopes the next morning. Good to have you back, Martin.
Hey, thanks for having me. Excited to talk about this new world order and our Governor Carney.
I'm excited to get some of that international take from up north too, man. I'm sure you've got a lot to say. And rounding things out, folks, we're welcoming back Johnny Matthews of Super Macro. He's spent over 2 decades trading and investing with a strong macro focus, and today he runs Super Macro, where he breaks down global markets and economic trends in real time. Always great to have you here, Johnny. Welcome back.
Thank you, Nicholas. It's great to be back on the show, especially with such a distinguished panel. Thank you.
And as everybody knows, the distinguished panelist he's referring to most is, of course, me. I'm brilliant macro mind, and there's no sarcasm in this statement whatsoever. So I'm going to jump right in here. We might be joined later by Jem Carson. We'll see what his availability is like. But to start us off, heading into the FOMC meeting, markets continue to kind of swing between pricing one or multiple rate cuts this year, while Fed officials have reiterated patience and data dependence following the December meeting. Now, with futures pricing continuing to move more aggressively, arguably, than the Fed's most recent projections, what should investors be paying more attention to right now? The Fed's guidance at face value, or kind of the market's expectations so far? Joseph, can you start us off?
So I think the market's in a tough spot right now. So when the market prices the expected path of Fed policy, it's trying to anticipate what the data will be and also how the Fed will react to it. But we're kind of in this weird position where we're going to have a new Fed chair, and maybe Jay Powell will step down, and Trump will get another appointee. So that Fed reaction function of this is really unknown. And so I think the market has a lot of difficulties trying to figure out just what this new Fed will look like and what its reaction will be. So whatever it's priced in the market, I think it's inaccurate, and there's really no way to know until we have more clarity to this. What we do know, of course, is that anyone who becomes Fed chair has to assure the president that he's going to go for a lot of rate cuts. The president was murmuring 1%. Probably something more reasonable would be what Governor Myron has suggested, maybe 3 or 4 cuts up to 2.5%. So I think right now the market just doesn't really know how to understand what this new Fed will look like.
Well, kind of on that note, projections for today sit pretty firmly low for there to be any cuts. It's pretty firm hold projection from like CME Fed Watch. Discussed that a little bit on our morning show this morning. And now that
Oh,
said,
I'm sorry about it. Of course, there's nothing happening. I'm talking about the rest of the year. Apologies. You're totally right. There's basically no chance that we do anything today.
oh, for sure, for sure. I just kind of want to like juxtapose that a little bit. Inflation having cooled meaningfully from its peak, that real policy rate, again, kind of remaining firmly positive. Is there a point where holding rates at their current levels becomes an active drag on growth? Or are we just seeing, like I said earlier, that tentative wait for data to come? Last Bear, do you want to tickle that one quick? And then I kind of want to kick it around the panel to see how everybody's feeling about today specifically.
Yeah, I mean, I personally don't think that there's a lot of evidence for the sense that, interest rates are a huge drag on the economy or will start to become one. If anything, we've seen tightening spreads, for example, in corporate debt issuances as well as mortgages, which obviously maybe the mortgage aspect is probably even more important. I think one of the biggest areas where we saw rate hikes in prior years impact the real economy was in the housing market, obviously. And so the fact that, mortgage rates have continued to compress, both due to sort of the base rate coming down as well as sort of compression of the sort of mortgage spread on top of that, really seems to be, I mean, I wouldn't say that the housing market is in a fantastic position, but it doesn't seem to be deteriorating. And I think more recent data seems to show that those mortgage rates are having sort of a positive effect on at least stabilizing, maybe in some places improving the housing market. And I think that's definitely the segment that's most probably rate sensitive, and that you could argue has been a drag so far. I don't think that there's really much evidence in financial markets, for example, that that current rates, especially given that they've sort of realized rates or effective rates continue to come down and have been declining for several years, is having a drag on capital markets activity. If anything, I think we see obviously the stock market continue to perform quite well, and even things like capital market activity, IPOs and follow-ons, and sort of all that sort of continue to heat up both last year and I think going into this year with the potential for some blockbuster IPOs and that sort of stuff. It doesn't feel like an environment that's particularly constrained by rates today. Obviously, the administration wants to, turbocharge things by continuing to sort of lower that barrier. But I don't think that there's a real case for that being a significant hindrance today. And I think that what the Fed is sort of, balancing now is the reality that they already have eased, somewhat substantially over the past 2 to 3 years. Growth continues to sort of look pretty solid, and they're balancing obviously what's the appropriate sort of rate going forward, and making sure that they're not sort of feeding into. So it looks like the Fed is taking a more balanced approach, but whether that can survive sort of political pressure, I guess we'll see.
Well, I think, um, look, fundamentals is a increasingly confusing word. We have incredibly opaque data reporting. Can't trust the numbers. Two, we have a administration that is doing, we have a bifurcated set of conversations about policy going on, right? We have what the Fed's saying, and then we have what the administration is saying. And as we know, the administration's about to announce a shadow Fed. So we're going to have two very different, Fed chairs, essentially speaking at the same time for the next 6 to 5 months. So my point is, it's uncertainty. It's not really about inflation or GDP growth nearly as much at this point as it is about broad uncertainty about policy. And then you layer in not just who's deciding what policy and what does that mean, and what are the actual numbers to begin with, which are increased uncertainty enough as it is. But then you bring in the broader uncertainty of as we've highlighted before, about a fiscal dominant populist environment where spending is not monetary policy driven. We're transitioning from a supply side economic model to a demand side model, which, as Arthur Burns laid out, they encourage people who haven't read any of his, the Fed chair from the 70s under Nixon, read any of his papers, but he's documented during times of fiscal spending and government increased involvement, it's incredibly difficult for the Federal Reserve to deal with their dual mandate. And so this is not the last 40 years of Federal Reserve policy where it was based on are we entering a period of cyclical growth or a period of cyclical slowdown? There are structural inflationary pressures, and balancing those is increasingly difficult in a political environment. So coming into the midterms, last of all, not only is this a structurally difficult period, and there's increasing uncertainty and opacity and different players, but you're dealing with an administration that broke that fiscal dominance, populist kind of call it 8-year movement to go against political, their populist rhetoric, to do very supply side economic model at the beginning of the year as well, and now are being forced kicking and screaming to, much like Nixon was, to do much more fiscally dominant policy all of a sudden again, and that creates a dramatic whipsaw effect, a dramatic amount of uncertainty. So if you're wondering what's driving kind of volatility and uncertainty, it is not the two-dimensional, is it inflation or is it growth that we've talked about for 40 years. It really is a different regime, a different set of players, opacity of data, and opacity of who's doing what, and these are big questions with dramatic consequences.
Thank you, Jem. To just kind of piggyback off of that a little bit, Johnny, from your point of view as well, how do you feel about that notion that shifting from supply side to demand side and kind of the connotations therein?
Well, first of all, I do want to just make one point that volatility is really, really low. If you look at Treasury vol, it's close to a 3 or 4 year low at the moment. So rates volatility hasn't really picked up as a result of this uncertainty. And just to address the risk, the increasing risk of fiscal dominance that we've been discussing up to now, one of the things I'm really less sure about is just how dovish and compliant this new Fed will be. We have 4 new regional Fed presidents rotating on for this meeting. 2 of them are outright hawks. Beth Hammock and Laurie Logan are notable hawks. Anna Paulson is a dove. We know that. Neil Kashkari, he flips between being hawkish and dovish. He's quite pragmatic. Then we look at the governors, and at the moment, there is this suspicion that Christopher Waller Um, he really wants the Fed chair job, but I do think he is also very objective in his views of where policy should be. And I don't think he is the kind of person who would act to curry favor with the president. Let's put it this way: he about a month or two ago, he was on TV making a quite a robust defense of Fed independence. He said he's got a 20-year. He spent 20 years of his life working on central bank independence, and there's a long paper trail of this. So, this idea that the Fed is just going to suddenly become compliant to the president's wishes, I'm not so sure about that. Even if Rick Reeder becomes the chairman, sure, he's an outright bull, but he does know a thing or two about fixed income markets, and he's going to make sure that the long end doesn't get completely trashed by investor fears that the Fed is going to be super dovish in the face of what looks to be a fairly healthy economy. So I think, as just getting back to what Joseph said, at the moment, we are very, very uncertain to what the reaction function of the Fed will be. But I'm more of the view that I don't think the new Fed will be quite as dovish as perhaps the market expects.
Thank you, Johnny. Now, just kind of back on this financial conditions in general, they've repeatedly loosened and tightened over recent months, and markets kind of oscillate between optimism around rate cuts, then concern over lingering inflation. A lot of stuff just seems to be really momentum based and people piling in. But when equity rallies ease financial conditions ahead of actual policy change, I wonder if that at all undermines the Fed's effort to keep policy restrictive. Martin, I'd love your take there.
Yeah, I think there's a lot of factors that the Fed would want to consider in regards to being restrictive. Equity markets and the amount of liquidity driving those equity markets certainly is one of them. Trump, back things up a little bit. Politics drives policy. Let's just not kid ourselves. In Canada, looking at what the speech Carney did in Davos, that was very much politically driven. He's only a couple of seats short of a majority, and playing Canadians up against American policy works very well in his favor. In regards to the U.S., again, politics drives policy. You have midterms coming up, and you need policy that's going to support the administration and has fallen out of support by the general population. And that is easing, and that's the housing market, and that's why they're putting a lot of pressure, in my opinion, on interest rates. And the housing market is a core component of Main Street and of the voters. It certainly is in Canada due to the demographic profile and the control they own over the votes. If you look at housing, it's gone no bid, and home sales are the lowest level since 1995, and mortgage rates are still high. And so you'd like to see, some support there. Gasoline prices are certainly very much helping the Main Street, but it needs more than that. So I think that the U.S. dollar is something that we haven't talked about yet, but I think it's a way of the Trump administration, getting some stimulus by cutting rates, by letting the dollar slide. It's reducing the debt servicing costs, it's stimulating exports, and it's accomplishing what he wants to, or what they want to achieve politically ahead of. But that's creating all kinds of instabilities everywhere. In Europe, for example, with the euro being near its highs, especially against China, that's pegged to the dollar. You have the Canadian dollar that's still still okay, and the Bank of Canada keeping rates flat recently today, and then the bond markets and in the metals market as well too. And so that political narrative driving policy is having a global influence and a whole bunch of unintended consequences that I'm very curious to see how it's going to play out.
Yeah, I think just to jump in here real quick, to answer, I think there's two issues being discussed here, and they're related. But one, 100%, I want to make sure everybody understands that Fed policy is a far second, as big and important as the Fed is, far second to market outcomes. There's $500 trillion of long assets in this world, include stocks, bonds, private equity, private credit, real estate, right? $500 trillion. If we get a 10% appreciation in markets and assets, that's a $50 trillion collateral increase. People don't think about it that way, but the dominant force of given the financialization and leverage of markets is the market itself. It's not even close. And so, to look at Federal Reserve policy in a vacuum, how much QE are they doing? What are they lowering interest rates, and how much does that affect things? Is to miss, how much liquidity does that increase? Is to miss the big picture. Is that the primary driver of liquidity by far is markets themselves. So the most powerful force that the Federal Reserve has, as well as, by the way, the Oval Office is, it used to be called the bully pulpit. The reality is, if the Fed speaks and it projects market moves, the move that happens in the markets is actually the driver of liquidity, and it's dramatically bigger. So the problem becomes when the Fed or administration begins to lose their ability to project market moves with their narrative. And we've seen that happened last year. Last year, they gained a bit more control, partially because they did dramatic supply side responses. But that's really the big question. So, to the extent is, does the narrative and does the market move pull forward or affect, the outcomes of the Fed and the administration? 100%. That's the whole story. The market is the story. The entities that are loosely being able to navigate and push the markets around is what we focus on. But they have a tenuous, often dominant, but at times they lose control. And when they lose control, that's when problems begin. And so we've seen this time and time again the last several years. Markets are weak, so they, or they want to project some economic strength, so they project out on the dot plots and in commentary, and then a cut, and then all of a sudden inflation picks up and growth picks up before they actually do anything. And that's really the critical point. So that's the answer to that question. But agreed with Martin as well. There's a separate topic that they're increasingly put in a box because of the political. Politics is the story. Populism, by definition, is political. And this is why election cycles matter so much during these populist cycles. This is why, we had a very different administration in year one, because of they had a mandate, they had the ability to go against the populist kind of policies and to try and push a much more capital-friendly, business-friendly approach in a populist kind of environment. And I said at the time, there's a lot of exuberance in December of 24, January of 25 about the change that was coming. Guess what? We're amidst a dramatic populist wave, resurgence, fiscal policy coming online, and whether it's 10% caps on credit cards, or it's checks to military families, or go all the way down the line. The policies coming through are incredible. Like amounts to capital controls, and this is very similar to Nixon. I mean, Nixon rolled back the Great Society program, opened up China, did a dramatic amount of supply side economics as soon as he came into office, and was forced, kicking and screaming due to politics, by his midterms a year and change later, to institute price controls. And I think this is a very similar. Again, we talked about it here live just over a year ago. So this is back on track with the bigger multi-decade trend. And really the last year was a bit of an aberration. And the fact that the world is now looking and assuming, what happened last year which is an attempt to get back to the 40-year trend, is reality. I think is missing the big picture. Is that politics is on a crash course with monetary policy, and that's going to drive some really difficult outcomes for the Federal Reserve.
And I'll just add what's going to be curious. Markets are, as we all know, are forward looking. And when do they start? Are they ignoring the existing Fed and looking past to the new one? And are they looking towards what the government's going to look like in following midterms? When does that happen? And then how is the impact going to be on the markets? Because it did so in April. It was able to correctly anticipate in regards to the lack of impact of tariffs on the consumer. Everyone's worried about that. There have been fallouts in other areas that I had just mentioned previously. But overall, we're probably going to see these equity markets change in the next month or so, or 2 months, because it's looking past what we're seeing right now. So the big question is today, is it really that relevant? Today's FOMC, is it really that relevant considering what I just highlighted?
Can I just make a couple of points here?
Please do, yeah.
Yeah. First of all, in the past, when the Fed got really, really proactive, one of the arguments was that financial conditions have tightened. And what they meant was that, equities were on their arse and credit spreads were blowing out and things were going kind of haywire. And that was an excuse for easing or stepping up the quantitative easing, whatever they were doing, really going guns blazing to support the markets. That is not the case now. Market, as I'm not sure who it was, whether it was Martin or Jem, one of the speakers previously said credit spreads are incredibly tight, whether it's investment grade or junk credit, spreads are incredibly tight. If we also look at the Fed, the funds rate right now, inflation is close to 3%. We've got a funds rate of 3.625. A 1% funds rate was typically real rate was typically considered neutral. We're down at close to 0.5%. So it's very difficult to say in any respect that conditions are tight. And when we look at the labor market, Powell himself said that because we have, currently net migration has fallen close to zero, it could even be negative now. The supply of labor is much reduced. The break-even level of job creation that we need to keep the unemployment rate stable is probably, Powell said, between 0 and 60,000. I think it was the Dallas Fed did a study recently where they came up with a figure of 30,000 a month. That's all the job creation you need to keep the unemployment rate stable. So I just think it's very difficult to make a strong case for easing at the present time. That's not to say the administration won't be piling pressure on the Fed to ease, to just keep the show on the road. But I think for a lot of these Fed governors and Fed and voting FOMC members, I'm not sure they see the need. I know others on this panel may disagree with me.
I think that what Johnny is saying is absolutely right, and that's what's in the market pricing, right? The market agrees with Johnny. It's not really pricing nearly as many cuts as you would say, listening to the president's rhetoric. But I'll make the case of why the argument would be for more cuts, and that's what the people who are more dovish, they're not saying that I'm going to do this because I'm under political pressure. What they will tell you is two things. One is that they'll tell you that the labor market is weakening, and if you look at a trend of the unemployment rate, it's definitely trending higher. And if you look at the earnings reports from companies, they'll tell you the same thing. We're not really hiring. When I was reading the transcripts from the big bank earnings, what surprised me is that if they're all saying that, well, next year is going to be better, but by the way, we're cutting some people. And you also have news today that Amazon is cutting people. So it seems like in some industries, this AI thing really is weakening demand for labor. and that's going to push up the unemployment rate. Now, the second thing that I think it's more of a new thing that all the wannabe Fed chairs are arguing for is productivity boom. And I have to credit Johnny with this because last year I was quite bearish on the economy, thinking that we're not having job growth, so obviously we can't have good GDP growth. But Johnny rightly noted on this discussion last year that we could have a huge productivity boom, and that seems to be that seems to be what happened now. And if you look at the FOMC dot plots, they're all revising up their GDPs, and they're not really doing much with their employment. So the implication is a productivity boom, and some would say, like you saw during the tech boom. And so if that's the case, that's downward pressure on inflation as well. That's coming down the train. And so you should follow Greenspan and so forth, and not be hiking into this, or you should be cutting. So I think that's the standard argument that's put forth by the more dovish members of the FOMC.
Thank you, Joseph. And I love the callback there to Johnny too, because I really like having all the context that all the panelists have. And I just want to touch a little bit there, just to kind of skim the surface of the labor market, because I do have some other questions about employment dynamics as well. But just kind of off the top, since we brought it up a few times now, Nick Timmerhouse over at Wall Street Journal actually described the labor market pretty similar to that. He called it a no hire, no fire equilibrium. And so I guess my question here is, as you guys just noted, it's a kind of unemployment's kind of stemming a little bit more, it seems, from hiring simply disappearing rather than layoffs. Even though some layoffs are happening, it doesn't seem extremely severe on the surface. And so I wonder, is that a dangerous equilibrium to be in, where that labor market unemployment rises not from layoffs, but simply from hiring disappearing? Les Bear, do you have anything to kind of tickle that topic with?
Yeah, I mean, I think that there are elements that help explain sort of the current dynamic. Obviously, the first one that always needs to be mentioned is that, the weakening in the labor market for the past 2, 3, 4 years came from probably one of the tightest labor markets, arguably that we've ever had, at least in modern memory. And so there's some amount of just like normalization happening. At the same time, a huge sort of supply issue, with respect to the level of immigration. If you look at the job growth in let's say 2023 and 2024 basically perfectly matched what was estimated to be sort of the net immigration in the country, whereas now that's come basically to a halt. And at the same time we see job growth come to a halt, but the unemployment rate, even if it's ticked up a little bit, has kind of stayed relatively flattish for some time. So I do think that there are a lot of balancing factors that make it hard to sort of see through to, basically this cycle looks very different than what, you would traditionally have in many of the past economic cycles, where you have sort of a peak in labor market dynamics that sort of rolls over and then sort of accelerates to the downside in some sort of, recession or depression, and then sort of, find a bottom and come back out. I think that we're just in a very different cycle, both respect to, the past unusual decade, as well as things like the fiscal spending that we're sort of continuing at a level. We're at 6% gap in terms of the deficit as a percentage of GDP. I mean, that used to be reserved for deep depressions, and now that's just sort of the status, the status quo in good times. And there's structural factors to that make it almost impossible to reverse that, even if we do Doge and go after fraud. They're just not going to make a significant dent. I mean, tariffs, to one extent, I think, to Trump's credit, the tariffs have brought in actually a pretty significant amount of money, something like 360 billion a year, which which is meaningful in the scheme of things. But overall, we have this fiscal impulse that's just continues to pump money, continues to sort of continue to juice the economy. And I think that's an element that also sort of like plays into this, where you have circulation of money that isn't necessarily totally hinged on employment. So I think that it's what we've seen basically is, for the past year, job growth basically stall out, and yet that doesn't seem to impact spending or GDP. And I think it's just we have to be careful about making extrapolations based on historical precedents that just don't really apply.
Martin, I see your
I,
hand there. Go ahead, man.
yeah. Okay. So we're in a really unique situation right now. If you look at Social Security outlays, given the aging demographic in the U.S., and you put that combined with interest payments on the federal debt, it now matches the entire federal revenue base. So you have three options you got to face. You have to grow your way out of it, which is the ideal situation. That's not happening. I mean, GDP numbers are good; they're okay. I think Goldman Sachs was saying like 2 to 2.5% this year. And so it's okay. It's chugging along. That's not going to grow your way out of this. Number two is you cut your spending, and that is not going to happen. You know, that voter base, as I mentioned earlier, age driven, or the demographics are going to keep you in office or vote you out. Or three, debasement. That's what we're happening. That's what I see right now. So, and that debasement, the big question is it helping those looking for work or hurting them, right? And those who are looking for work probably don't have a lot of assets to hedge themselves against that. And so I'm of the position that you should be cutting spending rather than interest rates, and that will help the job market and those looking for work, those who don't own as much assets, more so than cutting rates and inflating those assets. I know that's a pretty radical statement, but you know, gold going to $5,500 is telling you something there.
Yeah, we'll definitely double back to gold because I have a lot on that. But first, I wanted to touch on what you just said there, like the job hunt struggle. CNN actually reported that in December of last year, the probabilities of finding a job hit a record low of 43.1%. And so I guess I kind of wonder, uh, even though job openings remain elevated, I can't remember what percentage it was, but it was reported that a good chunk of those weren't even really being offered. And so I wonder if that compounded with, that probability of 43% of even finding a job that CNN reported, does that suggest labor demand is actually overstated, or are firms just becoming unusually cautious?
Well, maybe there's a shift in the type of demand that's happening. Like, if you look at young people, I mean, this is why we're seeing changes like in New York. You're told in the old days, you go to university and you know you get out of school and you're going to get a job and your life's you're going to be able to buy a house. And now you go to school, 1 in 4 graduates from university are not finding work. That's insane. And then you got to leverage up at 10 times your income to buy a house at a 6% mortgage rate. Again, another problem. So, is it systemic, or is it the type of work that is in demand right now? And is there a mismatch, or is there some bigger issues?
And we
I have a
can't talk
business.
about, sorry, go
Oh,
ahead.
just small. I have a business idea, guys. How about we create a university for podcasting and for newsletters?
Hey, I'm in. I'm in. Let's go.
But I mean, this is the root of the problem, right? Like we can talk in platitudes and talk about like, this is what the, is ideal for policy. We need to reduce spending, right? But how do you, in a world where we've sent money to capital and, to what I call Planet Palo Alto, right, for 40 years, and driven a supply side boom of technology that obviates the need for humans. We've globalized, these corporations have taken, this is their incentives. I'm not saying they did anything wrong, right? But they've gone to the lowest labor place they can and reduce the need for, Western labor. What are as those voters who have been labor since they left college in in the 1990s or early 2000s, and even now, how are you paying, how are you buying a home? How are you paying off your debt from college? How are you, starting a family?
50-year
And that,
mortgages, baby.
right. And so, at some point, you can't just keep doing the same thing. These are not cogs in a wheel. Cogs in a wheel would, the answer is very clear. Just keep pumping more oxygen, more money into the air and let evolutionary capital forces take over and build more technologies and create advancement and growth. But these cogs are human beings, and there's a fairness issue that politically you cannot avoid. And we created the Federal Reserve to smooth the business cycle. Everybody loves that idea. That sounds great. But the problem is we gave them one tool, which is monetary policy, which is sending money to corporations or not sending money to corporations. There are no people involved. And we gave them two mandates, which is price stability and essentially GDP maximization. We call it, maximizing unemployment. But I'm not sure that that's 100% true either. And at the end of the day, you give any machine those incentives, and this is what you get. You get dramatic inequality, and with if you're a hammer, everything you see is a nail. And so we put the Fed in charge of the whole economy, and the Fed has no mandate to deal with equality. So at some point, the release valve in democracy is government has the power of the purse, and government has to step in. And when the second government does, the monetary policy machine short circuits. That's where we are. That's what's happening. Yeah, we should decrease spending. That makes sense for optimal, efficient outcomes. But what about the equality question? And that's where we are. That's the big picture. We've talked about it here for years. And they can try and go back and do the same levers. But what about fairness? What about equality? And the AI technological boom is only making it worse. Okay, so there's only really one way out. We can avoid that outcome for a year or two in a political cycle, but that's really the big question.
I'll add on to Jim's point that, you think back to how central bank policy was for the past 20 years, right? After the great financial crises, there was kind of an austerity movement throughout the world. And so if you are a central bank with an inflation mandate, or if you're in the US with an inflation and employment mandate, that austerity movement really doesn't help your goal. And you just have this one tool and you're trying to achieve this really big goal. So as the fiscal authorities step back, you have the central bankers step in to fill that void. And the solution that Bernanke came up with was just the wealth effect, right? You pump assets up really high, that improves spending, and that helps the economy. And that seems to have morphed into what we have today. Paper One says it's kind of a K-shaped economy where you have people with assets doing really well. Now, on the aggregate, that looks like it works, right? Because that's keeping unemployment low, because these really wealthy people who still have assets, who have been inflated in part due to monetary policy, that's fine. And if you're a central bank, you're targeting aggregate numbers. And so on the surface, it looks like you're meeting your goal, but you have these huge distributional frictions where a lot of people are basically have no hope of ever buying a home or ever gradually advancing. So these frictions are becoming increasingly important, as Jim notes. So this is in part due to design, and probably why a big reason why that there is more and more question as to what role a central bank should play and how much say the executive or the legislator will have in how a central bank behaves.
Johnny, I saw you on mute. Did you have a point as well?
Yeah, a few points. I mean, it's a very difficult situation for the central bank. Earlier on, we heard the argument for lowering rates so that people could perhaps get lower cost mortgages and help things along that way. But if you do somehow successfully lower the mortgage rate, then it will just boost the price of houses. So it's very, very difficult. In the UK, we had a help to buy scheme where first time buyers were given some sort of benefit to help them get on the housing ladder, but it just pushed up the price of houses. So there is no easy solution to this. And one of the other points that I wanted to make, just getting back to this business of K-shaped recovery, the Fed regularly does a consumer household survey where they look at the spending by wealth or income decile, and, and there's this popular idea that the top 10% are responsible for 50% of the consumer spending going on at the moment. That's not borne out by the Fed study. The Fed study shows that I think it's the top. I think you have to go to the top 30% of income, the top three income deciles, to get to 50% of total consumption spending. So, and also, if you look through history, if you look at the how this has changed over time, it hasn't changed that much. I don't think the Gini coefficient of the US is getting any higher. If it has, it's moved up marginally. But there is this common perception that the lower classes are being left behind. I just think the US has always been a very capitalistic society. It has been like this always, and the idea of trying to normalize things and to make things much more even is very, very difficult to do. It just is really, really difficult. But that said, if you look at the billionaires that are around today, the tech billionaires, they came from most of them came from very modest incomes to start with, fairly modest income households. So that is the thing. There is this wealth mobility. There is this, you can start off relatively on modest means in the US and become very, very successful. And that's not necessarily the case in other countries. So, the US is doing some things right.
Thank you, Johnny. One thing I wanted to harp on really quick, just kind of like a slight mention earlier, but just one more thing on the labor market. Wage growth itself has stayed pretty stagnant, moderated from pandemic era highs, but it is still above the pre-2020 norms, especially in like service sector jobs. And I wonder, and Les Bear, I'll pick your brain on this one. How much further cooling would the Fed really need to see before feeling comfortable that wage-driven inflation risks are actually contained?
I think like where things are now, I mean, you mentioned, I think that wage growth has been, maybe it's a little bit higher than the prior decade, but it's been pretty stable for the past year or two. And at the same time, other metrics within the labor market don't necessarily scream wage price spiral. So I don't think that that is going to be a key concern, at least at this point. The other thing just to mention on on prices and that side of the mandate, I know people have various opinions of truflation, but it has been interesting to watch, that metric sort of really take a dive in the past couple months or past couple weeks, which we'll see if that comes through in official data. That can be a lot noisier than the official data, but it will be interesting to see, if we see inflation tick down in official gauges. I think that that gives the Fed a whole lot more room to feel more aggressive on the on the policy perspective. But I do agree. I think that at the same time, people have talked about the wealth effect and the K-shaped recovery and the 1%, all that kind of stuff. I do think that at the same time as all that happens, what you are going to see is policy changes sort of driven by anger in this in this dynamic. And I think that whether it's populism on the right or left, I think that increasingly you're going to see candidates that are coming forward with what previously might be considered kind of radical or fringe ideas being embraced by a whole lot more people than maybe was the case, especially among younger people. And so whether if you're going to set up an economic system that sort of perpetuates this discrepancy, at some point there's going to be potentially policy action that tries to rectify that. Now, whether that'll be successful or not, we'll see. But I do think that that's something that we shouldn't be surprised to see policy measures that before wouldn't have much traction at all continue to gain traction, especially amongst younger people.
Thank you, Last Bear. So I'm going to pivot here 10 minutes before we get some data dropped on us and touch a little bit more on equities and gold. Now, Reuters commented when gold hit 5,000, which as of we've seen quite clearly now has hit the rearview mirror pretty handedly as of yesterday even, and then obviously overnight we saw quite a rally up from there as well. And a lot have said that the rally itself has been driven by a falling dollar, geopolitical risk, renewed trade tensions, worries about Fed independence, persistent safe haven demand. Given this backdrop, though, what exactly does gold's ascent into these consecutive all-time highs really imply about market confidence in the US dollar, especially given that equities have been rising kind of right alongside with it? Now, Jem, I know at least a year ago, man, on this very show, you mentioned the potential for blow-off tops and things like gold and silver. Kind of seems like that's going on. So I would like your take here. What are we looking at with everything moving up together?
In 2020, early 22, we were very clear when gold was floundering near lows and nobody was thinking about the structural inflation that gold would be the best performing asset for the next 10, 20 years. So buy it with leaps, do it with leverage. Gold call was also incredibly low. Importantly, it wasn't just a directional call. 60s and 70s, gold was the best performing asset by far, and it was also the most volatile asset. You had a chance to take advantage of both of those trends with leverage. That has been a trade that has made your career if you were in it for the last 3 years. It is not over. This is another 10 to 15 year trade. That said, it is going to be much more volatile. I mean, it's been volatile to the upside. It will be a two-sided trade. It is not going to go in a straight line forever to the middle. We have yet to see any meaningful breaks. In the first early stages, this is what happens. It's a sharp, steep run, and then speculation comes in, and you have fundamental buyers and you have speculative buyers. And so the word is out. Everybody sees what's happening. It's becoming everybody I talk to is now asking me about getting into gold or silver or platinum. Everybody that wasn't talking about it 3 years ago. So the answer is these things don't go in a straight line. We will get something ugly that will wash out a lot of the speculative longs, but the trend is higher. This is why implied volatility, despite dramatically increasing in calls over all this time, is still the right way to play it. But if you're still just YOLOing from 3 years ago, or particularly if you're in the underlying asset or Delta One kind of stuff, it's the out of the money calls that are going to make this work for you and to manage the risk on these positions. Volatility is your friend. It is expensive. I hear you. And there are ways to take advantage of that. But I would say this is a very important time for precious metals, and it is a bit of an inflection point, given the coming transition in the Federal Reserve, giving the move, the whipsaw I already highlighted, just one of the most important things that people can be focused on right now. Last year saw a lot of tremendous trends, that are like the 40-year trend that we've, in my opinion, are moving away from into a regime change, reignite briefly. And again, that was because of an administration that came back in and tried to move away from a lot of the 4+ years of strong fiscal dominance, and they're being forced kicking and screaming back into bigger regime change trend. And so I think it's an incredibly important time to see what's happening and to realize that the last year or so, what I don't think will happen is in 22, everybody who is a RIA or advisor who had a precious metals allocation got bailed out from the correlation breakdown of bonds and equities given how crowded that is, the RIA space. How many people have used precious metals now as their diversifier, their tail, looking back at what happened in 22? It will, if equities decline with equities this time around, and will not be a safe haven, in my opinion, in the next pullback. But the secular trend is still alive, and will be, and you will see another dramatic rally after a bit of a washout. So that would be my view broadly on where we are. Timing is tough, but I do think at this point, early in the year, given what we've seen, it's a good time to to be thinking about things in that way.
And I do think that maybe Joseph might kind of be inclined to agree with that a little bit, because I saw your post, Joseph, that you offloaded both your paper silver and your giant silver hammer. What do you think? Is the highs in for now?
Yeah, that post went out a bit viral. Um, so when just looking at silver, it looks like there's a lot of momentum in that. And what I've observed is that over the past few years, you kind of have a character change in who participates in the market. You have a lot of people who go and just kind of lever up and just rush into and chase momentum. You saw that with NFTs, with meme coins, with crypto and so forth. And you see it in a lot of sectors in the US equity markets too, like uranium and so forth, and sometimes in some tech stocks. So I got the sense that they are in precious metals now. And I think the secular trend in gold continues to be higher. But then when you have this kind of volatility, and if you look at a price chart of silver over the past few decades, periodically it goes to this moon and then it just kind of implodes. In silver in particular, I think it's a bit different from gold in that it's actually an industrial metal. And so when you have a lot of speculators pumping it up, that impacts the interests of, say, industrial policy, maybe national security. And so that's something that impacts people who have strong interests. And so when we saw what happened with the Hunt brothers in the 80s when they squeezed it, the powers that be kind of step in, and they can basically rig the game so that makes it go down. So I don't have that same concern with gold, which I think really is something that's going to be, like Jen mentioned, in a secular uptrend. One of the interesting things I've observed is that so when we have this sell America trade because of geopolitical risk that emanates from the US, everything gets sold except gold. You saw that in April last year as well. So I think that is going to play a more useful, I think there's more awareness that can play a useful role as a portfolio diversificator.
Thank you, Joseph. Martin, I saw that you raised your hand earlier. Did you have some points to make on what Jem and Joseph were saying?
Yeah, it's pretty important. I posted a chart on the chat. Equities versus gold are when measured gold are a 12-year low. You want to look at what's going to be your debasement hedge and what's going to protect you the most. And it's certainly not going to be housing anymore. I think that trade is sailed. Equities, yeah, it's okay. Bitcoin's certainly not the case. And in talking with here in Canada, we're so stubborn with the 60-40 bullshit. I'll say it because this is the way it's been, and it's always going to be this way. Well, there's a fundamental shift in 2022. And if you're not paying attention to what's happening globally in Japan, for example, or other areas, and the shift, you got to sell something to buy something. And if they're selling treasuries, they're buying gold, with the exception of Canada, because we don't own any gold. It's kind of funny that way. And so having some in your portfolio is a necessity, even with the rally over 5,000. If you don't have at least a couple percent of gold in your portfolio, you're not doing it. And I've got hard dollar. I'm managing large portfolios. I have to have that in my portfolio to protect against debasement. If you look at your dollar, the value of your dollar is 74 cents in a dollar from 2019 if you just kept cash. And that's just going to kill you. So either you got to spend your money right now, or you find something to protect yourself. And gold is one of the things that's working for now. And adding on what Joseph said, I had silver and I had a big position. We doubled our money on it. It's too speculative, and so we rotated all that position into gold. And I'm happy buying more at $5,500.
I think it's important to everybody's talking about gold now. Of course it is. You get the triple, and everybody's talking about precious metals. But the key story in debasement is that you have anything that has fundamental value, anything that you can consider a hard asset, particularly anything that could be perceived as a strategic asset in a world of multiple entities bidding for what has limited supply. At some point, those things, it's not a matter of global supply, it's a matter of who can access what supply. And so, similar to what happened with the OPEC crisis, commodities writ large, industrial commodities, particularly things that are strategic, that are in a world of a multi commodities, particularly things that are strategic, that are in a world of a multipolar world with geopolitical conflicts. Strategic assets are the game, and you could think of gold as that hard asset, that debasement trade. It's the classical one, that is one. But I think the key is not to get so focused on gold and the currency dynamics to miss the debasement realities and you know agriculture, farmland. I think there's an incredible opportunity in things that are forgotten and not thought about, like Alcoa and aluminum, given power inputs. And of course, the one that's been left for dead, energy. I think energy is the last one to move. When it moves, it will be the last way out. The tip of the spear has moved, but the rest is kind of following behind it. And I think the key is to approach that in a very diversified way. You can rotate through them as opportunities present themselves on a multi-year basis. But I think to just look at gold and precious metals is missing a lot of other opportunities that might be much better.
Fair enough. Thank
I'll
you,
just add that
Jem.
we just had the FOMC. What I think what's standing out is that we had two dissents this time. Not we expect Governor Myron to dissent, but we also see Waller also dissented as well. Again, Waller, as we know, is one of the candidates for Fed chair. One difference is that Myron is dissenting, and he would just like to have 25 basis points instead of his usual 50 basis points. So I think Waller's dissent is a surprise.
Looks like in the short term, at least, markets might agree with that pretty hefty move initially on the NQ, for example, up to almost 26,200 and right back down to almost 100. A little bit of a wiggle going on. What else are we seeing, folks?
Well, I think the statement had to be changed. And they have. I think that the statement says unemployment rate has shown some signs of stabilizing. The previous statement really said, let me just see what it said. It said the unemployment rate has edged up through September. This was the December statement. Downside risks to employment rose in recent months. I think economic activity has been expanding at a moderate pace. I haven't seen the latest statement, but obviously those things needed to be modified because economic activity has been expanding at a fairly robust pace. I am surprised that Waller did dissent in favor of a cut. I thought he had more integrity, but clearly he wants the Fed chair job. He wants to keep himself in contention, and I suppose that's the only way. I'm not sure what else there is that's much of a surprise. I mean, Treasury volatility is just on the floor, and there's been virtually no reaction in the Treasury market to this. I mean, Treasury futures have ticked down a 30-second. It seems to me like there's very little market reaction to this. It was all very much expected. There'd be no change in rates. I suppose the big surprise is that Moran only dissented in favor of 25 rather than 50, as Joseph said. And for me, I'm surprised that Waller dissented in favor of 25.
All right, last bear, Martin or Jem, anything you want to add so far about the drop or the dot plots before I start hammering some more topics home?
Yeah, I just want to make sure people aren't just focused on the the traditional story of what did the Fed do and what the dot plots, but be prepared that not only is what Powell's going to say here important. It's important about what's the likely announcement coming from the administration on who the Fed chair is. That's probably coming in the next 48 hours. And then what is that person likely to project? So that's probably coming. So don't just think about what's said here. It's what's the contrary argument going to be based on what's said here, and how is that perceived? So I think there's a bit of understand there's multiple Fed meetings happening in the next 48 hours, not just.
Yeah, the other
oh,
element to add, I would say, is like obviously the subpoena of Powell seemed to cross a pretty big red line, and I think it'll be interesting to see if Powell addresses those issues. I think obviously the politicization of the Fed has been a topic since Trump's been in office, but I think that he probably did overstep and recognizes that he did probably on some bad advice from certain members of his circle that got walked back pretty fast. But it'll be interesting to see if that more aggressive tactic ends up backfiring and sort of creates a more resolute Fed as a result. And interesting to see if Powell talks about it today.
I took a look at compared to last month. It looks like they softened more of the with more of a hawkish tilt on the employment side. That job gains have slowed, and last month and employment has edged up. Now it's saying job gains have remained low and showing signs of stabilization. Also, I was looking to see if there was anything in regards to changes to reserves or balance sheets, because last time they had mentioned the initiation of purchase of shorter term treasuries. So there's nothing further there that stands out.
All
I
right.
think one thing
Oh, go ahead, Joseph.
to look for today is if we have any more information about whether or not Chair Powell will step down after his chairmanship ends in May, um, because otherwise he could stay there and you could actually have a shadow Fed chair there, but not the kind the administration wants. So if we have if he offers any insight on his plans, and you know you can't really remove a Fed governor unless for cause, and that's not defined, and we're going through this litigation to see whether or not Governor Cook can be removed. But you know an open question is, let's say that if for whatever reason Powell does get criminally indicted, is that for cause, right? That kind of creates a pretext, that some ambiguity, some space to try to have more influence as to who can have that seat later on.
Yeah, and importantly, to follow up on that, on what Joseph said, that Cook decision by the Supreme Court is probably the most important thing that's going to be decided in the next year period. I mean, point blank, the by far the most important thing. If the administration is able to coerce and come to its outcomes, have leverage over Fed members, which is what that decision is basically going to allow or disallow, their power increases infinitely. And by the way, I think the biggest decision probably by this administration about who they make Fed chair is who they can most control, who they can most depend on. You could say it that way, to carry out their policy decisions, not the independent Fed decision, but their policy choices, and how much power can they commandeer from the Federal Reserve. And so that influence and how much control they have is going to be essentially decided by that Cook Supreme Court decision. And so by extension, the independence of the Fed is at stake in that decision. And so by far, the most important thing, the Fed is the most powerful entity in the world, I would argue. People might disagree with me as it stands. But if again, that power is then commandeered by the executive branch, we live in a very, very different world at the moment that happens.
So I'm going to pivot a little bit here, and I want to go back to something that was said earlier regarding spending. Martin, just a few hours ago, actually, this morning, you posted, quote, with all the money printing since the GFC in 2008 and its ramp up to support continued massive deficit spending post 2020, the move in the S&P 500 has been an illusion in real terms. And Martin, to be frank, kind of putting on blast my brain here a little bit. I'm going to need an explain like I'm 5 on that one. Can you help me out?
So all I did was, and I talked about it earlier, I posted a chart showing what the market was priced in gold. Gold, it has a limited supply, and you just can't print it. Not yet, anyway. And so, I mean, we're all looking at these things. We're all saying, okay, my house is up here, my stocks are up here, everything's great. But let's look at what you're getting bang for your buck. And this is why the debt market is so, and this is why we need low interest rates. And let's take a step back in the 80s when mortgage rates were 13, 14%, you were better off than you are now. Because you could buy a house for 1.5 times your income with a 13% mortgage, and as a percentage of your disposable income, you're further ahead. Today, you got to take on 15 times your income in some cities, and the rates are doesn't work at 5 or 6%, and so you're better off with less leverage, and that's simply because of the value, the depreciation of the purchasing power of your dollar. This reminds me a lot of when I worked in capital markets. I spent 10 years in investment banking as a research analyst, and we did an IPO of our boutique firm. And of course, as a young whippersnapper, I didn't get a lot of equity. And then when the share price rocketed from $5 to $25, all the insiders wanted to get out, and then they went to me and said, "Hey, young whippersnapper, you just be a team player. Let's sell you our stock in a secondary at $24, and we'll give you a multi-million-dollar loan to do so by one of the Canadian banks." And I said, "Well, that's fine and dandy, but give me a put protection on that." And they said, "You're not a team player." Well, thank God I didn't do that, because the value of that stock went from 24 back down to 2, and I would have been wiped out financially. And we are in a situation today where we're trying to provide leverage so people can offload their assets, or an aging baby boomer at 71 years old owns a pile of stocks and houses, and they have to find a buyer for it, and there isn't, without leverage. And that's what I'm saying, is that the value of what you own is important. Now, that one chart, it's you're much better off being invested in the market, absolutely, than sitting in cash. And there's a lot of people sitting in cash, and they're going to get killed. So it's just a matter of recognizing what the long-term trend is and zooming out, because debasement is separate from inflation, and it's something that we need to be cognizant of.
Thank you, Martin. So I just a little bit on GDP again. Economic growth, I mean, it's remained positive entering 2026. Joseph had that comment earlier in referencing Johnny about the GDP going through 2025 into 2026, but it's argued that a lot of that resilience has been driven by consumer spending rather than, business investment. And it's also been shown that I think something like the top 10% of earners, again, to that discrepancies we discussed earlier, are who make up something insane, like 90% of the spending. Paraphrasing, so don't quote me on that. But how is that really sustainable? How sustainable is a growth mix that relies so heavily on consumption, even as households face tighter credit conditions, slower income growth, and frankly, the ability to find a job, really? Joseph, could you start us off on that? And then anybody else? Yeah, Martin, go ahead.
Jump in quickly. I have to jump for another meeting, but I just wanted to say thank you, everyone, so much. And thank you guys for having me. It's been a real pleasure this time. Thank you very much, guys.
Hey, always a pleasure to have you on, Martin. Thanks for coming while you could.
I think that goes back to Martin's illustration, in that I think you just have a generation of people who are really asset rich, and they are selling it and using that to finance their consumption. Actually, Martin's story reminds me of what I saw when I went to try to sell my silver, right? There's a long line of people to sell silver, all of them boomers. And there's only one person in line to buy silver, and that was a Zoomer. And, you know, we'll see how that turns out. But I think there is this kind of this just, you have a lot of people who've just accumulated a lot of assets and are be able to finance their consumption from that.
And so just kind of to further a bit of my curiosity there, is that concerning at all? Is that, demonstrative of something that's not necessarily being tracked as much in terms of growth?
Well, can I just jump in and make a couple of points here?
Yeah.
Yeah. First of all, the fact that the savings rate did fall recently in the most recent income and spending data that we had, that is largely because total income growth has slowed, because total employment growth has slowed to, I think it was just 0.37% year on year. That's the number of jobs that there are in the economy. The job growth over the year slowed to 0.37%. Now, productivity gains lifted GDP. That's kind of the wrong way to look at it. We typically, you look at GDP and you look at the number of hours worked and you back out a productivity number. But there's something inconsistent about an economy that's been growing at something like 3% a quarter for the last 3 quarters. I mean, the Atlanta Fed is estimating over 5% for Q4. It's probably going to come in at closer to, well, 3, maybe 4 max. But so let's call it 3% per quarter for the last 3 quarters, and yet job growth has slowed to a virtual standstill. I doubt very much that there has been such a productivity miracle that that the US has been able to achieve that kind of output with so few additional employees. And I think what's happened is, we've already discussed, there's a very, very low level of layoffs currently. It's close to a half century low. But firms have slowed down their hiring decisions. And I think what happened during last year, we had the uncertainty from the tariffs, we had the uncertainty from the government shutdown, and now we have Trump's chaotic policymaking, which is adding a new layer of uncertainty. But I think at some point, companies can only delay the hiring decision for so long. At some point, they are going to have to start hiring again to manage the demand that's in the economy. Domestic demand has been very, very strong over these last 3 quarters. So I think at that point, as we see stronger growth in employment, we will see stronger growth in total income, and income and spending will be in better balance. The savings rate will move higher again. So I think this idea that consumers are just sort of running down their savings and or maxing out the credit cards, I'm not sure that's quite true. I do expect things to normalize. As far as the economy is concerned, consumption is 70% of GDP. So it's kind of, you can't get away from it. We are a consumer-driven society, and that's how modern societies are. So you've got to keep the consumer happy. You've got to keep them spending.
Fair enough. Thank you. One topic we didn't deep dive, but we just kind of tickled the surface of. We've got about 11 minutes now before Jerome Powell takes the podium. So just kind of like quick tidbits here on the bond market, on yield curves. So Treasury yields have kind of remained elevated relative to pre-pandemic norms, even as inflation has cooled a little, and it's kind of keeping attention focused on the shape of that yield curve. And so just kind of a generalized to the panel at large, what really is your take on long-term yields at this stage as a signal about inflation risk, fiscal supply, or structurally higher neutral rate? Let's start with Last Bear, and I'd like to kick this one around.
Yeah, I mean, I think that there's still plenty of room for sort of spreads to increase to sort of more historical norms that would sort of, be a combination of the short end coming down by some degree, and the long end either staying flat or even increasing. I think that we're still at a very flat curve relative to sort of the normal circumstance. Part of that, I think, is driven by the forward guidance of the Fed. That didn't used to be a case prior to 2012, and really might change the way in which sort of the yield curve is shaped going forward. But yeah, I mean, I think that, like, there's on the long end, there's sort of the big existential questions about federal spending, the strength of the dollar over the long term, the countries being less and less comfortable with holding reserves and U.S. Treasuries as opposed to other assets or hard assets. And I think that those are sort of like big long-term trends. And then at the short end, people kind of are willing to look past those things, because even if you have sort of a multi-decade debt spiral, let's say, that's probably actually not going to necessarily impact what happens next month or next year. And so I do think that there's sort of this, we're holding these two sort of really different concepts simultaneously in our head, which is, what is, does it make sense to hold a government treasury for 30 years at a 4.5% rate? Given where we know sort of the broad secular sort of really unstoppable trends are in terms of spending and demographics and healthcare and social security and everything else, versus practically where's the Fed rate going to be? Where can I get a little bit of spread? What's the best place to sort of optimize on whatever sort of quote unquote cash position that you have in the near term? So I think there's personally, I think that there's plenty of room on the long end to continue to increase, especially to the extent that the short end might be sort of nearing the bottom for this cycle, absent some sort of depression or recession or something like that. So yeah, I think that those, you're going to see increasingly two different schools of thought playing out on different ends of the curve.
Thank you, Last Bear. To kind of continue this vein of thought, when backward looking GDP data conflicts with softer forward looking indicators, which should policymakers, and by extension, even investors, which should they place greater weight on at this stage of the cycle? Uh, Johnny, do you want to go ahead with that one?
Yeah, yeah. I think there's been a bit of a disconnect between these forward-looking indicators and what the resulting economic data have subsequently shown. I think the relationship between many of them broke down after the pandemic. Certainly, we see that in some of the PMIs in Europe. In the US, if we look at the consumer sentiment surveys, I mean, the University of Michigan survey, they changed the methodology. So rather than house to house conducting the surveys, in person, it's now done online, I believe. And I think people are much more willing to give a very negative view of the economy online rather than face to face. So there was that kind of disconnect about a year or so ago. But all these, if you try to find some sort of match between what the consumer sentiment surveys say and what consumers actually subsequently do in terms of spending, the relationship is really, really not very good at all. So I think you've got to be very careful in reading too much into those types of surveys. And the same thing, in fact, with the PMIs. I put a chart out on my Twitter space the other day about how the ISM manufacturing index has really, really understated the growth in manufacturing output in the US. Manufacturing output has grown something like 2% year on year for the last 3 or 4 months. And yet, if you look at the ISM manufacturing index, it's still below 50. So there has been this disconnect, and people are supposed to try and answer the survey questions objectively, but I just think they give a subjective assessment, and it's been far too downbeat recently.
And so kind of one more to that end, if growth, and again, I know I spent a lot of times asking questions that equate to superlatives and hypotheticals, but if growth slows toward trend without turning negative, would that be enough to justify further policy easing? Or again, in the traditional sense, notwithstanding the changing landscape with midterms coming up, does the Fed tend to view that outcome as evidence that the current stance is working? Let's go Joseph on that one.
So I think it's important to remember that the Fed's mandate is price stability and full employment. Growth is not in it. Growth is often associated with employment and things like that. But what we've seen is strong growth, potentially through productivity, probably overstated, and a weak labor market so far. That looks like it's been improving. Now, in thinking about the Fed, I personally think that the Fed's reaction function is going to be different when we have a new Fed, new composition of the Fed. I do think it's going to be more under the influence of the executive. Now, I do understand that we do have the Fed presidents that rotated on the FOMC are more hawkish, but you have a president that's been squeezing Fed governors, squeezing the Fed chair himself, and in the political totem pole in the U.S., Fed president is very, very low. It's honestly just not even it's a like a employee of a private sector nonprofit actually. So I think we're heading into this new phase where we're going to have more of a populist regime, like Jim mentioned, and that is going to entail a more uh, politically influenced Fed. One of the candidates, one of poor Fed chair Rick Reeder, he's actually kind of on board with that. If you listen to what he says, he's like, the Fed, not interest rates not super effective on managing the economy. You're going to have to partner with fiscal authorities and so forth. You've been making some MMT like analysis saying that hey, when we have really high interest rates, sometimes it doesn't really work that well because you increase the interest income of people who have a lot of cash or fixed income. So it's a different way of looking at how the economy works. So I think it's very difficult for the market to price that in. In going forward and looking what rates would be, I think it's going to be more about listening to what the political leaders would like it to be, and they definitely have the tools to really set the curve to whatever they want it to be.
Beautifully said, Joseph. Thank you. We've got about 3 minutes before Jerome Powell takes the podium and gives us some beautiful words to coincide with the data drop from half an hour ago. I just want to real quick, each of you, where can people find you? What's something that you're working on? And kind of send these folks into the Jerome Powell presser with some bright eyes and bushy tails to learn more. Let's start off with Joseph and just work our way right down the line.
Well, first off, thanks so much for having me. You guys should definitely follow everyone here. I've learned a lot from all of them. If you're interested in learning more about what I do, I have a YouTube channel. It's called Joseph Wang, and after the FOMC, I will post a debrief of as to what I thought happened, and just highlight some points of the FOMC meeting press conference.
Thank you, Joseph. Definitely check that out, folks. I learn a lot of stuff when I pop into those little releases he does. They're not super long. They're really concise, and you're going to learn a ton from them, 10, 20 minutes. Jim.
Yeah, absolutely. I mean, one of my highlights every 6 weeks is getting on board with all these brilliant guys and getting to kind of pontificate on the world. We've gotten a lot of it right over the many years, and kind of again, steel sharpens steel. I think is I think it's been wonderful. So thanks for including me. But if anybody wants to reach out, kaivolatility.com. You can do kaivolatility.com/news if you want to get on our distribution list and see what we're talking about every week. Kaiwealth.com if we can help with broad non-correlated wealth advisory, focusing on risk-adjusted return in this increasingly difficult 60/40 world. But yeah, thanks for including me. Good luck out there.
Thanks as always for coming, Jim. Last Bear, where can people find you? What you're working on?
Yeah, you can check me out here on Twitter. Also, find a link to my Substack in the bio. I also launched a portfolio on a new platform called Plutus that people can find through my links as well, with some small cap contrarian type plays that I like, that you might find interesting. Only other thing I'd mention that I don't know that we touched on in the conversation that I think is relevant for the year ahead is midterms. I think that every lever that can be pulled by the executive branch in a positive growth fashion is going to be pulled. We've already seen a lot of those type of announcements come through, and I think that's only going to increase going forward, and that'll be a factor to watch going forward. So thanks again for having me, and yeah, talk it next FOMC.
Thanks as always for coming, Last Bear. Looking forward to it. And bringing up Anchor, Johnny, where can people find you? What you working on?
Yep, certainly they can go to my website, super-macro.com. I publish, you can get a free subscription for 30 days. I publish a daily newsletter giving a run through the day's macroeconomic data and markets and the impact on the markets. And once a week, a more detailed look at markets and the impact of and policy announcements and economics. So just go to the website, super-macro.com, sign up for a free trial subscription for 30 days. If you like it, you can run with it.
Good deal, Johnny. And as
Thank you
always,
again
thanks
for
for
having
coming,
me on
man.
the show. It's been great.
All right, everybody, give me just a few seconds. I'm going to flip over to the audio of Jerome Powell's presser. Feel free to stick around with us. If you missed it, don't worry. This will be uploaded right here and on YouTube and on Apple and on Spotify with the full discussion. You didn't miss anything at all. For now, I'm going to get this audio set up, and we will listen to Jay Powell go.
Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a
give it a
similar
try.
answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So, I have nothing for you.
But, I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. So if you had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, the Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira.
Thank you, Chair Powell. Mara Mokwe from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
You know, we haven't made, you're right, we saw the labor market weakening and we acted. And I think that was the appropriate thing to do. We have, you know, we will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that. I'm not making a judgment about how, you know, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you know, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, you know, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
You know, over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, you know, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But you know, right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that, you know, in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. You know, the thing is, I mean, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but, you know, it's much more, you know, assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between, you know, 10-year rates and the overnight rate.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. Just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that? So
you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. And, consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. we don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you, Chair Powell. Bayi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly precisely when this will happen, but there's an expectation that sometime in the middle quarters of the year we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9-month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we will be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is, a lot of it is around energy, oil. And so far we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of, certainly, of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind-Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI. We're all over that. And, everyone studies those periods, and, we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything. And so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
If you came in late, you missed anything at all, you didn't miss anything. This is going to be put up on Apple and Spotify as a podcast episode on Unusual Whales. Other than that, folks, things we got coming up, we have our Whale Watch show here right on X on the Unusual Whales channel every Monday and Wednesday at 9:30 a.m. Eastern. You can also check out our new tool, Unusual Prediction, spotting unusual activity in prediction markets like Polymarket. Other than that, folks, I hope you have a great rest of your day. Thanks for hanging out with us. Take care.